Good morning, traders. Welcome to the Flow Show. New week begins. Good morning, Mr. K-Man. How's your weekend?
Good morning, Ryan. Good morning, everybody. Hope you all had a nice and relaxing weekend. Yeah, mine was very quiet, actually. Didn't do much. Watched a bit of football, did a bit of cleaning up, and that's it, really.
Yeah.
I didn't clean my charts, rest assured.
Save that for the spring, the old chart spring cleaning.
Exactly.
Definitely. Right, well, let's get stuck into it. Have a look at what's going on in the world. China is apparently going to accelerate its issuance of government bonds, according to Finance Minister Lan Fong. That was out via Xinhua Press. Over in Japan, they're going to give tax breaks to medium-sized companies, or the government's going to give tax breaks to medium-sized companies, according to the Nikkei. So part and parcel of these measures designed to get stimulating the economy, if you like, and also to help with price pressures too. We had the September meeting minutes out from the Bank of Japan. So this is September, not the meeting last week. So they're a bit behind, so not really key. No real comments in that, though it does match. They have repeated in October what they said in September, which is that hitting their price targets is not yet in sight. BOJ's Awida has been out overnight with some more comments, latest comments, if you like, rather than the September stuff. Pretty much reiterating what he said after the BOJ meeting, saying that they can't see the price goal in sight with enough certainty, and the key to that is whether wages keep rising and if that practice becomes embedded. So all about the wages again. It says next year's spring wage negotiation is particularly important. Doesn't see negative rates, or the chances of negative rates ending in 2023 are low, and that they will keep YCC and negative rates until the price goal is in sight. Now, caught a headline, I can't remember it, just first thing this morning, that one of the firms in Japan is looking for 6% wage rises in their next negotiation. So this is something to pencil in for next year, for the spring, when the wage negotiations come around again. That could give a bit of a secondary input into inflation and get the BOJ closer to their 2% inflation goal. Certainly that's the key measure for the Bank of Japan, changing its tack as well. We have got some data out of there as well. It's Services Day around the grounds. Where are we going? Come down to Monday or Sunday night. Here we go. So Services PMI in Japan coming in a little better than expected, 51.6, better than the 51.1 expected and prior number. So everything looking okay there. Coming over into Europe, we also had data out from the European nations as well. Services not looking too hot in some and others. Spain looking better, into expansion or further into expansion, beating the contraction expectation there. But Italy went further behind, 47.7 versus 48.5 and 49.9 previously. France as well, worse. Germany, a touch better. These are all final numbers, so a touch better than the flash number, but still down on last month, 48.2 there. But as you can see, into contraction on that one. The pan-Eurozone number, 47.8, coming in as expected, the flash number and previous reading as well. No services PMI for the UK just yet. That's coming up. I haven't checked yet. I think it's tomorrow or Wednesday. But construction PMI out there, also a bit of a soggy number, up on last month, but missing expectations for that one. While we're in the UK, BOE's Peel, speaking after the BOE last week, said the rate hold decision reflected the view that some restraint on the economy needed to be maintained, and we're not yet really entertaining the idea of cutting rates. Not yet really is not exactly a definitive. We are not talking about rates. So a little bit, maybe just me picking something out of nothing, but sounding a little bit flaky on that one. Right. Big data that we got last week was obviously the jobs number out of the US and also the ISM. So a little bit of review what happened on those numbers. So non-farm payrolls missing expectations, coming in at 150 versus 180 expected. The prior month, the big 336 was revised down 40 odd K to 297K. Unemployment rate went up, a bit of a double whammy because the participation rate dropped as well. Usually if the participation rate drops and nothing else happens, that can bring the unemployment rate down. So the fact that that dropped and unemployment went up was a double negative there. Wages, though, up a touch, 4.1%, still banging around this 4-point area. 4.1s, 4.3s, that sort of area. So still remaining pretty solid. That gets better the further inflation falls as real wages rise. Overall, the numbers, the market made a little bit of a song and dance about them being weak. Really, if you take both months together, average them out, you're looking at about 220K per month. So, you know, taking, as I say, both those together, we had a big outlier upside last month and a little downside miss this month. But overall, I don't see any problems coming in here regarding the jobs market. Yeah, unemployment rate has ticked up a bit, but it's ticked up before and then gone down again. I don't know your thoughts, Kay. Has the market gone a bit too far in
Well,
into it?
take the numbers standalone on Friday. We can see a bit of a slowdown. The thing is as well, what we have to note is that I think it's 3 or 4 months now in a row that the past number has been revised down. That is one. You mentioned the participation rate and everything. If you take it standalone, okay, there's one can say that the number is weakening or less strong than before, but you're absolutely right. There is no panic to have had to have based on those numbers. Now, what has happened last week, and I said it at the start of the week, I think we are going to have to take the whole thing as one big picture, and the one big picture is, for now, Goldilocks, and looking forward, the doomsayers or the people taking the negatives or potentially slowdown have not been proven wrong. And as I was saying, we had an unhawkish FOMC, and that's the result where we are now. I think the market needed a breather. The market needed to get a confirmation of what it wanted to see. Probably already the positioning as well. Too long dollars, too short equity markets, you name it. And then people getting out of short-term treasury futures positions, and it all came at once. And also people remembering that the seasonals are better for equity markets in November, a bit weaker for the dollar, and it all happened in the space of 3 days. I'm not saying it's done. I don't disagree with those moves at all. There was room for corrections, and I'm not going to take the word turnaround already up personally, because yes, we had like a pretty decent setback in the dollar globally. Sterling being one of them, the commodity currencies being the other. But for the time being, we're still trading that is really the Goldilocks scenario came back in full force in the second half of last week, and that's really the jobs report gave the market the same thing. So we did not, how shall I say, counterbalance whatever happened earlier in the week. And I think that's just where we are now. So now we have to see what's coming up next. Is there more to go? I think we will see what the Americans want to do with their own currency, with the equity market, especially the bond market as well. But I will show in a minute where we are in the yields market and stuff. Yeah, I mean, that's it. The move is there. Has it finished? I don't know. It seems like the European market is quite happy to at least keep those levels going. Especially, as I said, cable, Aussie, Kiwi, and the euro to a certain extent as well. And what's been standing out for me as well is that emerging markets have done really, really well. Look at stuff like dollar rand, dollar mex, even dollar China is nearly a percent lower. So yeah, turnaround, I don't know yet, but at least we cannot completely dismiss this move. At least not me. I'm can try to see if there's corrections in this move or whether it's done or so, but we may not yet be done with this move. But just to say that, I mean, the whole package of last week is pretty in line with the moves that we are seeing now.
Yeah, very much. I mean, just going back to that NFP, yeah, we have been trending lower. We seem to trend lower and then get these little spikes popping up of decent numbers, and that might have just been another one. That 336 that we got previously. The trend has been low, but it's not at worrying levels just yet. I mean, who knows? Next month we get, we're into the area now where November, December, heavy holiday hiring usually seasonally. That can impact numbers. Mike says you've got to add the 35,000 jobs from the auto workers strike. I'm not too sure what about that, Mike. I don't think the picture's been completely clear about the impact of those strikes. If it was a strike on day one and it had been running for a month, that's a different thing. But these strikes have been on and off between different plants, different firms, different workers. So it's not been like everyone's been out of work for months at a time. They're taking a few days strike here, a strike there, back to work, that sort of thing. So that picture's become a bit messy. I don't know what's going on with it. I was expecting to see some of that in the jobless claims numbers, and it doesn't look like we saw any of that really. So I'm going to dismiss those strikes and their effect for now. But yeah, as I said, the trend has been coming lower in the jobs market, but nothing that signals a collapse. Until we start getting some negative numbers and those negative numbers start trending as negatives, I don't think there's anything much to worry about.
Yeah, if I just may ask, add just a word there. We also will have to look now at the consumer, because I've seen several comments on the consumer having overspent a little bit, or at least pull the plastic out and overspend a little bit. It's going forward. It's those kind of things where we will have to really pay close attention to see if we are actually turning around the corner right now. And I think somewhere Powell. I think two things happened last week as well with Powell. It's not that I'm convinced or in the knowing or whatever, but I think there's been a little bit of how shall I say, cooperation or chatting together between Powell and Yellen as well. And then I think he starts to feel that the slowdown is actually on our doorstep, perhaps. But then the thing is as well, I mean, if you look at the dollar, then, and I know this market, the dollar is the biggest market, and we have seen those moves in all the dollar pairs. But let's not forget that the rest of the, especially the majors world, is still undergoing a period of much lesser growth than the US. So that's why I'm saying we are going to have to be careful to completely write off the dollar at this stage, I reckon.
Yeah, that's why I asked. Really, is the market got too overly negative? Because the data up to this point, PMIs aside, have been pretty solid. We're expecting to see, the housing market maybe find trouble. It hasn't. Consumer hasn't. All the signals that we've had little yellow flags pop up now and again, but overall, the data the last month has been solid. And then we got that GDP number.
Yeah. But I mean, it's typical for a market who always tries to look through some stuff.
Yeah.
It's like, all right, let's compare it to what happened in the Kiwi. We had this weak jobs report, and then we had like a 1-day move, but then market already looking through that and saying like, well, hang on a minute. The dollar this and the euro that, and then the Kiwi actually strengthened quite a bit, even against its cousin, the Aussie last week. So the market is constantly trying to look through, and again, I mean, what happened end of 2022 is now happening again, and the market saying, "What this is it? Now we are going to go to get weaker and weaker data out of the USA," and that's why I'm saying we got to be careful, because the market could continue for a while with this kind of line of thinking, right?
Yeah, but I mean, the market is always bearish. It doesn't matter how strong an economy is; it's always bearish. Always wants easing. Nothing's ever. It's either dovish or hawkish. There's no in between with the market, and it's always dovish for a central bank. Look at the pivoters, the beginning of this year, coming in and trying to forecast rate cuts, and it started again. After everything that's happened, all the headlines I see are where the market is pricing cuts. We had the ISM. The ISM wasn't too hot either, as you can see there a bit later. Headline, employment down. Headline was down. The only bright spot was new orders and prices ticked up in the ISM there. So, and after that, what did the headlines come out? Well, chance of a Fed hike by January falls to under 20%. That was after the jobs data. The first rate cut for the Fed is now priced to the June meeting versus the July meeting, and swaps are showing more than 100 pips of cuts price for 2024. We've been saying this for the last few months now, probably since the summer. We're going to be playing the cut game coming into the end of this year and into the start of next year, and here we are already doing it. They're doing it for the Bank of England. 2 25 pip cuts priced by November 2024. The ECB 50 pips of cuts by July 2024. This is what we're going to be trading, which makes you think, when you see all that coming through, and meanwhile euro dollar's making a fresh high, you've got to then judge that if we're going to be playing this cut game, it's going to be similar to the opposite way when the dollar strengthened through all the rate hikes and the last few rate hikes. The dollar is going to be the big game for rate cuts. That's the one that the market's really going to move on. But what's going to happen still is, we're still pricing pretty much late in the year for the BOE. We're pricing middle of the year for the Fed and the ECB. It's going to be the data that decides if those cut calls come much further forward, so to April, May, March, that sort of thing, and that's going to decide prices. Particularly these, can the euro sustain a gain when it might be one of the first to cut ahead of the Fed? That's the way you got to look at it. Same with the pound, same with cable. At the moment you'd think that the Fed are going to be the first to cut. Well, I'll say perhaps that's not going to be the case. It's going to be the BOE, still my favoured ones to cut if we see the economy fall, because it's going to fall probably harder and faster than the US will. So you got to look at some of these price moves like in cable and think, okay, is this real? If that continues up 125s, 27s, and it's all because of the market getting overly dovish on the Fed, then you've got to think, is that really going to play out? Is that really going to happen? Is the US going to collapse faster than everyone else? It could happen, but the evidence so far in the data suggests it's not.
Yeah, but the only question right now, I reckon, is that when is the market balanced again. I mean, it was
Yeah.
tilted very much towards a stronger dollar, and people short bonds and all that stuff. And when is the market balanced again? Is it lasting a week? Does it have to last 2 weeks, or are we done? After 3-4 days, everything's possible. So
Yeah.
at this stage, I think we are in a bit of a balancing act right now. But we
Yeah.
will need perhaps fresh data just to drive it around, as you say. And I don't. Well, I mean, everybody's already talking cuts and things, but I don't think that actually the real money that is going around is perhaps already thinking about cuts, but they just have seen very good levels in things that have held, and then they need to adjust their books, right? And
Yeah.
but there's a lot of money flowing around in the market, so that book adjustment can take a while.
Exactly. I think when we talk about money markets pricing this and swaps pricing that, this is, without being too disrespectful, this is the kids running around chasing the trades. The adults are still sitting on the sidelines with their wallets closed. They haven't decided yet when really markets sell, when banks are going to cut, and when that comes in, that's when you get your final pricing, and then you find your balance perhaps. But like you say, this could last a day. We could get the next piece of good US data out, and we turn around again. So you just never know at the moment.
Yeah, and that's what I've been saying since the start, actually, of the shows and stuff. And in our room, I've been saying that very often. People are always saying it, the market is pricing this, the market is pricing that. That's absolute crap, right? I mean, when it's not because that let's say, just to take it for an example, US tens go from 5% to 450, that the market is pricing cuts. That's absolutely crap. There's so much money in those markets flowing around that you just have people adjusting their books. And it's not that they price something in, it's that they say, okay, we come to levels where either I'm deeply in the profit and we are at levels, and those levels seem to start to resist, or like let's say the 5% on the tens, and there was a big support on the futures as well. So those levels start to support, those levels start to resist. We have seen the euro dollar 105, couple of tries below, didn't work. We've seen the cable 120, 121, didn't work to get below. So those people are saying like, oh, my model is slowing down as well. So perhaps we need to adjust the books, and that is what they're doing. The actual guys, I haven't seen whether it's Paul Tudor Jones, Griffin, even JP, whatever. I haven't seen them talk about, yeah, in the future, yes, but I haven't seen them talk. We are selling dollars because we expect rate cuts. That's where you're really going to see a big shift in the market. In the meantime, all this thing about pricing in, pricing out, whatever, it's just caused by flows, and the people are putting a text on it. But okay, we all have to look at what they do. But I just want to say there's a lot just flows going on, driving the market in one way or the other, without the main participants really pricing in anything or the other. There is just food for financial reporters and yeah, Twitter. Well, formerly known as Twitter.
It's derived from a result of markets moving. Fed swaps. You trade Fed swaps, you trade interest rate futures. And from that you derive, whether it's the red months, green months, front months, whatever, you derive what the market interest rate is for those periods, and that's where those calls get extrapolated from. Yeah, it's a result of how markets are trading. So if it prices 2 rate cuts by July, fine. That's because people trading interest rate futures, have been buying futures on the back of whatever data point dropped out, because that's what they do when that data point drops.
And it's not only people expecting what the market is going to do, because there's been enough articles around, and I've put another one in our newsroom this morning about China having sold treasuries for a while, because they needed the dollars to either sell dollar yuan against against the yuan, which was weakening, and perhaps put a piece in gold as well. You know, I mean, it's all those kind of things. But okay, I mean, if I start to talk about that, I'm going to be going on until F.A.C.E today and probably beyond. But no, we have to be. The only thing is, I've said we have to be careful when we say, oh, the market is pricing in cuts and stuff like that. Trust me, when really the big boys are going to price in cuts, there's going to be different moves. Trust me.
Yeah.
That's going to have a completely different look. So yeah, Mike saying like Powell was more neutral than dovish also. I think it's more a case of what I said is unhawkish, and that was enough also for some market participants to say like, okay, he's pausing, so maybe we should pause our positions a little bit as well. And yeah, it's just all of that came together in
very much so.
4 days of trading basically.
Yeah. Right, let me quickly finish off the headlines. Just on the stuff in the Middle East, we had that Hezbollah chief piping up on Friday, and the market looking to see if he was going to step up rhetoric. He waffled on. Risk got a little bit of a lift because he said in one of his comments that the battle is completely Palestinian and for the Palestinian people and has no relation to any regional issue. That's probably when a lot of people went, okay, thank you very much, and clicked it off. But Iran is still in the mix with all this because WSJ reported that they say Iran will hit the US hard if it doesn't secure a ceasefire in Gaza. So as much as this Israeli thing is looking like it's going to be contained, there is still potential for it to spread wider with Iran and stuff and create a bigger mess. So we just need to keep that in the back of our minds. We didn't see too much of the usual move or the last couple of weeks moves in risk into the close of Friday. Got a little bit of a rally up late in the day, but again, it's dissipated over the course of the morning. So maybe you could say they're still playing that game, but it's looking like that might be falling into the ignore column pretty soon, unless there's any big step up in hostilities. So one thing I mentioned about last week is for everything that goes on and you can get stuck in the middle, when you come to the end of the week, what has happened? What has changed? What is different? Well, we do have some breaks, obviously. Euro dollar has broken up through 107. So now we've finally, we've had this move off the bottom. It was still in doubt because we couldn't break up above any of the key levels. We were struggling in the 106s, then struggling in 107s. We finally made the break. Friday caused the break. Does this mean we're off to pastures new? Who knows? We have to keep breaking the levels. The next level to break is the 38.2 fib of the move down from 112s. To maintain the break, we've got to hold 107 on a test. So, yeah, we've got a break. It looks very good. We could be setting up a new upper range if 107 holds. We need to see what happens to the top side. Can we get through this fib easy enough? If that's the case, we're probably heading to 108. And then we see what we need to do there. So for now, it's a break. And why is it broken? Pretty much, and I'm going to answer this question here, Mike, that you've asked about cable, because it's the same reason. You're asking, has it put in a short-term bottom at 120.50? How long do you want to give it before deciding a bottom's a bottom when you have the price action doing exactly what it needs to do to form a bottom, i.e. first instance, stop going down? Cable's exactly the same, 120.50, 121, whatever you want to call it. We came down, we made a low, then we set a higher low, and we couldn't really bust that. Or if we did, we couldn't get to the lower low. So your bottom was in play for pretty much the whole of October, if you listen to the price action. It's easy to call a bottom now when you're 400 pips higher. Is it a short-term bottom? This is where you want to be looking for the price action as to whether it's bottom. This is what you want to be trading. Not this. You don't want to be trading. Everyone wants to trade it 120.50 now when it's trading 124. Why weren't you trading at 120.50 beforehand when the price action was down here, showing you that it's finding support down here? So am I going to call it a short-term bottom? Of course I'm going to call it a short-term bottom. It was a short-term bottom all through October, though. So, you know, no one's going to look a superstar calling a bottom now. We're trading 124s, Mike. But that's, you know, we were talking about this all the way through this period, what to look for. You know, that's one of the reasons why I bought euro dollar down at the 105s. Big old solid level, significant level. I tried it here, made some money, got stopped out on this move, got back in again, and I'm still in it because the evidence tells you exactly what's going on down here. So now I'm looking to see what happens in this move higher. Is 107 become decent support? If it comes decent support, I'm going to be looking to buy a test and hold of 107 to see if we get a push higher. That's if we don't continue on up from this point. As I said, you know, lots of breaks going on here. We've had a break in Aussie dollar, but we've still got a big zone up here. This is almost like the 107 in euro dollar, 65, 20, 40. You know, a decent zone on the way down, decent zone on the way back up. This is the level that it's really got to take out to turn around some of this move. But again, the situation not as clear because we did make that prior low. We didn't get as much evidence of a bottom forming after that low that we did in cable and euro dollar, but still we made that lower low and we never looked back afterwards. So then we started breaking up against some of the other levels. Some of the other levels started holding support. That's what you want to see in the break moves. The moves high. Now this is your question mark here, 65.20. We pretty much stopped it on the dime. If we can't get through there, then we haven't really broken this downtrend just yet. But if we get above there, then the picture changes somewhat, and I'll probably need to stick my fibs back on there that I keep taking off because every time we made a new low. Euro sterling quickly, then I'll hand it over to the K-Man. You know, this was looking pretty. So, you know, this is what you don't want to see. When you're getting a break up, you don't want to see it all collapsing and coming back down through the levels. You know, we had this move above the big old 87.20 area, but we just couldn't hold it. Couldn't hold it all through the last couple of weeks. And that spells trouble because if you can't maintain that break, you've got no chance of pushing higher. So it was a bit messy. You know, we had some highs, made a fresh high, then it couldn't get up again. Had the support down around 87, 86, 85, 90-ish. Back below there, back into my zone. So now we look like we might be back in the box on this one. And I've got to be sitting here strumming my fingers again, waiting for this move to continue. This is another setback, a bit like it was a setback here. Does it come all the way back down? I don't know. I think right now, the reason this is down is because, as usual, cable's got longer legs than the euro. So when it runs faster and it runs further. I see no fundamental reason why this should be weaker, but it is what it is. So once again, I'm back to waiting for a proper break of this 87.20 area, and then maybe we get a push up properly through this fib and turn this trend around more so. Okay, I shall.
Before you hand it over, before you hand it over to me, the reason also why sterling is running faster than the euro is sterling is de facto, whether we like it or not, a bit of a risk currency of late. Well, the past years especially, it has been the case for years, but it became very clear again through the pandemic that sterling is correlated a bit more to risk as well. So when the dollar weakens, it usually goes paired with a bit of risk positiveness, and I also think that the shot up there to 87.5 was a lot about month end, and then the euro sterling is already naturally a bit correcting, but I do think a lot has to do with risk as well, and probably the market. As usual, bearish sterling, and then when it turns around, it has to run for the exit and all together. Yeah, if you look at the cable, it was a really strong spike up from just below 120 again. I said in our room when we retested it, we're like a couple of pips below, and I said like it's looking pretty cold under 121 again, and that was the last time we saw it down there. Unfortunately, I only had a small run short euro sterling. I didn't really benefit a lot from the cable rally.
Yeah, I'm just gutted I didn't get my 121 move over the Bank of England and the data last week.
Yeah, I mean, yeah,
nice
that was just the day before, right? That we did that quick
Yeah.
spike under 121 again. It was a really quick one, and at the same time we did the euro dollar sub 105.20 very quickly, right? And
Yeah.
it flipped around. And I said like both like 105.20 and 121 in the cable were looking a bit like there was a lot of support down there. And yeah, it didn't. It then flipped around completely. Okay, I can look at a couple of things. First of all, let's look at what happened in those yields then. So this only two I'm going to show here. I don't want to take too much of your time, but last week I said like probably this is so we had this rejection here, tried it again, and then we started to come off last week. It's really, I think, a lot of it is book managing. There was a lot to do as well. I read articles about the base trade, futures versus bonds, a bit of unwinding as well. So this and the futures probably market was really short a lot of treasury futures, so that's been correcting. I still want to call it a correction right now for as long as we are holding those perhaps 430s in the tens. But this zone we cannot dismiss it. Okay, I said from 460, 454, and then you had a little bit of those prior lows here, just a 450. That's really your big first zone here, and we are around 459 right now. Now we really need to see what the US wants to do with that. Okay, Deriji, I'll have a look at it. Really want to know what the market wants to do with it, because if you look at the futures, they did exactly the same. They came from these low levels and started to ramp higher. On Friday, well, my trend line at least depends on the thickness of the pencil, of course. But my trend line, this was around your 454, I think, on those tens that I showed. So we went a little bit above. Dollar got a knock on the head again, but we are back inside. I would argue that we are back inside just. So now it's up to the US to really tell us what they want to do. If we get back above, and that's probably going to be your 430 somewhere in the US in the yields equivalent, might actually be a little bit higher because the futures tend to run a bit faster, right? So there is a case for this going back to 110 on the note futures. Okay, so that is if we get above again and we start to take out those prior highs around 108 and a quarter, 108.30. That could run up to 110. Nothing is excluded right now, especially when we look at these equity markets. It was a bit of a this crossroad that I showed, right? 43.10 up to 30, stretch it to 43.50, 45, and we are trading above. Okay, we are at 43.65. There's there is a possibility for as long as this level holds. I would say 25.35. If that 25.35 starts to give again, then perhaps the party may be over and we start to trade lower again. But in line with what's happening in the futures, in line with what's happening on the US 10s, this could go into the low 44s. Okay, 44, 15, 30 is in my opinion the next level. And a big zone coming up to 44.60 to watch on the S&P. Okay, there's still a lot of results coming out as well this week. So, but to me, we've had this big move higher together with what's happening in the yields. And if you go back onto the yields, even the 5-year have come to levels and broken a little bit on Friday, and we're back above those support levels on the 5-year in the US yields, which is also around 450. So keep an eye on those ones as well. So yeah, can we break higher? I don't know. For that, really, we should have data in the US that slow down, but do not completely fall out of bed. Okay, if you really crash into a recession into the US, stock markets are not going to go higher. They may do something like this, but if the numbers are really bad, I think then they go to go lower together with whatever US assets. Okay. Right. What else? Oh, your dollar China, Ryan, is doing pretty well. We
Yeah.
are, sorry.
Yeah, I don't know. I agree with you.
Yeah, we are on a bit of horizontal support here, but for those looking at it in the short term, that was a bit too close for comfort to the market. But if you look at it in a short term, we're breaking a bit through that channel, right? 729 a quarter or a half, I'd say. Keep an eye on that. And it's possible we are going to go to have a look in the 724.25 again. All those articles about PBOC and their bond selling, it could be countered by more and if you look at the government planning to issue more bonds, that should press the Chinese yields a bit higher. I think it's all part of a big plan. Now we have to see what the dollar wants to do. Really, I think this is a good zone enough to call it perhaps more neutral. If we start to really go below those prior lows, then I think something may have changed. And what the PBOC is doing may just be that stubbornly keep those fixings around here to try and force the market, if they get a bit of help from the dollar, to get back into that zone before they give up. Okay, we will. Now it's up to the dollar, in my opinion, to tell us what to do with it. Ryan already showed. I'm just going to show dollar yen. This is a fragile trend line because it's been created by two spikes here. But yet the low 149s is a bit of support. Then you look at 148, 70, 75. And then here, this is going to be more important, in my opinion. What's happening if we get down to 148, 15, 30? Without interventions, of course. Interventions can change a lot. We are turning around the 200 on the 4-hour as well. I don't know if we can. We're just turning below the 4-hour cloud. We're still a ways away from the daily cloud, which is still coming in a lot lower. But yeah, if the dollar stabilizes with what Ueda said, and look at the JGBs, they actually came. JGB yields came down as well. So that is probably Ueda's saying that don't hope for too much from our side. So that still puts really the MOF against the rest of the world, unless the dollar comes down naturally. Okay, that is going to be what we have to look at now. If not, if the dollar just stabilizing, I can see this just gradually creeping back up to just above 150 probably. Then we'll have to look where the rest of the dollar pairs are, and then probably we hear again from the MOF if it's again yen weakness, because look at what's happening in stuff like Aussie yen. We're banging against that longer term trend line again. Kiwi yen, we're back to those in those 89 long-term levels again. Look at sterling yen, on what a kind of a rampage that went over the past week, really. So if you look at the yen as a currency, it's still weak. It's still very weak. So that's why I'm saying it's still going to be MOF versus the rest of the world. Yeah, gold. Ryan already had a quick look at it, but to me, it's in between the goalposts here. Sorry about that. When this was the high, this 1954 was a fib where we just stopped on, so it's still valid. But for the rest, look, we are banging our head just above 2000 and 2000, and there's there's enough right now up here. There's enough to you see a bit of a activity area here, and this activity area is enough to hold it back. Yeah. 2006, 2012. All right, that's your resistance area, and on the way down, anywhere from 1968 down to 1962, and then take this 1954 as well, because it's that prior high around there as well, rounded up to 1950. So that's your zone, about $50 in which gold can trade. On the back of geopolitics, as we already said, it looks as if, and hopefully, the conflict stays more local than what was feared. But we are not out of the woods yet. If it aggravates, I think we can fly through. If it stays there, then it's now back over to the dollar, I reckon, to what's happening with gold. So I'm neutral here. You think you're Charlie? Yeah, I'm still in the position, mate. I've taken some off because we are in support zone here. We do have the RBA out, so keep an eye on what's going on. First of all, around 165.5, then around 166. Okay. If 166 goes again, then we're probably more neutral, and actually, we could argue that the euro is going to creep back up a little bit, or something happening with the Aussie post RBA. They expect it to hike 25. So yeah, I think I'm still looking for this to give way for a move lower, but patience. Okay, we first need to get over the RBA hump, and with that, back over to you, Ryan.
Thank you very much, mate. Yep, we shall call that a day for today. There's not too much on the calendar for this week. A few retail sales hither and thither, which we can look at in more detail tomorrow to see what's on the calendar. But until then, have a great week, everybody. Have a great rest of your day. Trade well, trade safe, and we shall see you all bright and breezy tomorrow. Thank you very much.
Hello.